Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading report for December 22nd, 2012. Merry Christmas edition. Market is bullish normal. It's neutral on an annual and a short-term basis. Annual 58 on a weekly RSI 14, 52 out of 100 on the 10-day NDX. Percent stretch relative to the 200-day moving average is 3.86%, so we're 1.86 away from sideways market. Slope of the 50 has almost leveled out at minus 0.04. ADX 14 has increased slightly to 14.9. It's still a weak trend. Bulls are slightly in charge. ATR percentage remains under 1 at 0.93%. I've added two new indicators looking at the risk on, risk off market condition. We're comparing the 30-period moving average to the 10-period moving average of ETF VXX. When the 30 is greater than the 10, it's considered risk on, otherwise risk off. To measure that, in order to compare it through time, I'm dividing the 30 by the 10, so anytime it's greater than 1, the 30 period is better than the 10, and that will lead to risk on. I've also gone back 4 years and computed some descriptive statistics, and today's moving average rating of 1.03 is a z-score of minus 0.25, so slightly below normal. Slightly below average, excuse me, but within the range of normal. I'll discuss more of that on the weekend webinar tonight for subscribers. Blended monthly rebalancing, no change to the portfolio, still a heavily global component. Next reevaluation on or about 1 January. The ETF2 model, theoretical exposure is 90%. The actual model portfolio will be at 90%. It's adding a position in China this weekend. The YouTube link goes to a short-term trade example on the YouTube channel. Quick look at the blended monthly rebalancing portfolio, self-explanatory. Looking at the market health check, the vertical blue lines are 10, 20, and 30 days worth of look back. Purple lines are price target support resistance levels in the past. We're hovering right at the one at 142. And in between 142 and 147. The support resistance of 147, we got to get through that in order to clear this congestion zone here from September through November, and for the bull market to really be considered back in force. The horizontal red lines are support levels from previous price excursions. Solid red line and the red shaded area is the 200-day moving average and regions below. The blue and light blue areas are the 30-period Bollinger Band plus or minus 1. That's the river in the floodplain. Thick black line, curvy line is the slope of the 30-period regression line, which is above 0, so sloping up. It's actually the point value of the slope of this thick black line in the center, which is the 30-period regression line. And the thick black lines are the regression line channel formed by the maximum excursion from the regression line during the look-back period. Thick green is a 10-period moving average, something like fair value. You can see right now we're in the middle of the regression channel or slightly below at the upper end of the river. Pulled back to the 10. You see how price was rejected at the boundary of the floodplain. And has come back to the Bollinger Band mean, or coming back towards it. The thick red line is the Bollinger Band mean. You can see that we've been overbought for a long while, and now we're back to about the midline on Williams percent R. The jaws of price percent oscillator or percent price oscillator are still open to the upside, so the upside trend is still open, but narrowing. So this is a staggering bull, if you will. It's come down and flirted with the 200-period moving average and has chopped its way up. Remember the last time it did that, it was a 15% move from 128 up to 148. and so this is about halfway back up a move of that type. The most positive sign is the slope of the 30-period regression line, and the fact that it's been able to ride the northern end of the north shore of the main river. So cautiously optimistic. This is a market moving up in fits and starts and waiting for the new year. Quick look at the ETF2 regional report. 9 out of the 10 indexes are on a buy signal. Looking at the 4-month moving average filter, that's why we're at 90% invested, 10% cash. The globals are doing better than the U.S., and inside the U.S. it's mid-caps, small caps, large caps, then tech. The two strongest sectors are Europe and Asia less Japan. The two weakest are U.S. tech and U.S. large caps. World market model tells the same story. Anything Europe is good. Selected Asia, selected Latin America is good. Oil, gold, and silver commodities, all of the alternate asset classes are below average, as is the U.S. with the exception of the mid-caps. You can see the weakness in U.S. tech. Strength is in financials and industrials globally and inside the U.S., but you can see the global is doing better than the U.S. in every category except energy. Quick look at the ETF top 30 from the ETF2 database. You'll notice the dominance of Europe and Asia. U.S. home construction, one of the few U.S. sectors that are still in play. Inside the Dow 30, sorted by relative strength. It's still the financials. Bank of America, J.P. Morgan, Travelers. We noticed over the last couple weeks just how strong Cisco has been. I like the fact that it's green on strength and white on average, meaning because the relative strength is the first symbol to change, and its consistency is pretty good. So Cisco is leading the way in tech land as opposed to, say, Apple or Intel, Microsoft, Hewlett-Packard, which you see down at the bottom of the stack here. So Cisco has something going on, as does United Technologies. That's good. So those are the early leaders coming out of technology's weakness. ETF liquidity just reports the average 30-day dollar volume and then shows the ATR, relative ATR percentage. Those in green are exceptional intraday tradables because of their intraday volatility. So that's going to be the VIX and gold miners and silver. We're going to shift now to the daily report. Looking at the gap statistic over the last 30 days, you'll notice that 12 times, 4 and 8, the market is gapped down. The gap down is reversed to close higher 8 out of 12 times for an average follow through of 0.42. So the pattern is now tipped to that in that direction. 11 out of 18 times the gap up has continued to gain for an average follow through of 0.46. So really, it's been the upside. The upside follow-through intraday has been the story. Time series of 10-day NDX, you can see how it's been oversold. Almost oversold. It's hovering right on the boundary. No signals in overreaction or channeling. You can see the volatility. It's pulled back up to normal, just under 1%. And ADX bulls slightly in charge as it has pulled up from a low of around 10 up to just under 15. So still plenty of room for the bulls to unwind and go north. A number of large caps and then XLP available on channeling and overreaction signals. Lots of 551Ws in both the large caps and the ETFs. Technology is dominant in there. And then in the auto framer, these all test out at better than 2 to 1 on a retest of the 10-day high. The 10-day max pains, Merck, Walmart, Home Depot, General Electric, and Hewlett-Packard. The winners, Disney, DuPont, JP Morgan, Bank of America, and 3M. It's the precious metals in the ETF 100 that are really suffering over the last 10 days. Silver, natural gas, gold miners, gold, and another gold. Dow 30 tactical summary. You can see a large number of channeling and overreaction, a handful of 551Ws. Nothing tests out at better than 2 to 1. Max pain range compression candidates, Walmart, Merck, Home Depot, General Electric, Procter & Gamble. RSI 2 signals in Procter & Gamble. That one should be interesting with an RSI of 2 and an excellent max pain range compression rating. Looking at the ETF 30, the same in the same lens. A lot of symbols testing out on the auto framer. Silver, treasuries, gold. Consumer staples should be of interest to us here. Channeling and overreaction signal, a max pain range compression, and a 3.8 value on the auto framer, and had an RSI 2 value of 2. Gold and silver both washed out Friday, so those are of interest, as is agriculture. Consumer discretionary, also testing out at 2 to 1, and it's a 551W. So XLP and XLV or XLY and XLP are of interest here. The slope of the 30-day regression line, you see the big gap down and then some recovery in SPY, so that'll be seen as a buying opportunity. The regression line is still above its 10-period moving average. That's a good sign. It's at the end of a 3.5 standard deviation move up. This is a place where it stalled 4 times in the past, and so that favors the channel trader. And you can see how much it's given back here based on Friday's big sell-off, which washed away the previous day's worth of gains. Natural place for the 30-period regression line to roll over. It's at 1.0 on the Z-score. The 10 and the 90 have both come back to the 0 line as well. This is both a natural place for it to fail and a natural place for it to find support. So this is perfect bidirectional short-term traders price location here. IWM in much better shape than SPY in terms of tradability and its location with respect to the river. Gold is disappointing. It has to find support at what was once resistance, otherwise this entire move up is jeopardized. Treasuries have started to make a little turnaround as a flight to quality. Quick look at the fraud candidates. Microsoft with a fraud quality number of 4.3. McDonald's, IBM, Johnson & Johnson also in the green. Signal to noise ratio for reference. I want you to notice the Z-scores in SPY. Over the 40-day Z-score is at 0.04, so at neutral. 0.15 for 10-day. 0.01 for the 10-day. Oops, sorry. And minus 0.31. So by all measures, it is right smack in the middle of its normal kind of moving, its normal breathing. So no advantage in either direction. So the advantage is if you can be flexible and trade in either direction, there are reasonable profit targets on both sides. And that's everything I want to cover around the daily. This is Ken Long from Tortoise Capital. Keep your powder dry and your risk measured.